In 2008, the housing market didn't just correct itself, it shattered. Millions of people lost their homes and entire fortunes were wiped out in a blink. Today, as we stand at the close of 2025, some of the numbers are starting to look eerily similar. But this time, there's a different kind of threat, a hidden pressure building beneath the surface that could make the market even more dangerous for buyers and sellers. So we're going to put the data from today directly against the data from 2008. We will look at side-by-side charts that reveal a pattern you simply cannot afford to miss. We'll break down exactly why this time is different, but not in the way you hope, and what you need to do to navigate what's coming. Stay with me because this is the real story the headlines aren't telling you. Before we dive into the charts, you have to grasp the strange reality of today's housing market. It's not crashing, but it is deeply unhealthy. It's frozen solid. Imagine a vast sheet of ice over a deep, dark lake. It looks stable from a distance, but powerful currents are building pressure just out of sight. On one hand, home prices are refusing to budge. After the wild surge during the pandemic, the national median price is barely holding onto a small gain. But that single number is hiding the truth. In more than half of all local housing markets, prices are already falling. On the other hand, mortgage rates have been punishingly high for 2 years. They've recently dipped into the low sixes, but that's little help for anyone trying to buy a home right now. This toxic combination has created a deep freeze. Sales have fallen off a cliff because buyers simply can't afford the monthly payments. Meanwhile, sellers who locked in a 3% mortgage rate refuse to move and take on a 6% rate. This is the lock-in effect, and it's starving the market of homes for sale, which artificially props up prices. But this fragile stability is not going to last. The first cracks are appearing, and that brings us to the echoes of 2008. This is where it gets serious. When we put the charts side by side, 3 patterns emerge that are disturbingly familiar to anyone who lived through the great financial crisis. First, let's look at home prices versus income. Right before the 2008 crash, home prices completely detached from what an average person could actually afford. Today, we are in the exact same situation, and in some ways, it's even worse. Even with prices going flat, they're still sitting on top of a massive 37% spike since 2020, while incomes have lagged far behind. This financial strain is screaming from a key metric, the debt-to-income ratio, or DTI. That's how much of your monthly paycheck goes toward paying your debts. In the run-up to 2008, it was normal for borrowers to have DTIS over 43%, a level that proved to be catastrophic. While lending is stricter now, lenders are reporting that their borrowers' debt loads are rising fast. People are stretching themselves to the absolute breaking point to get a mortgage. Lenders say 43% is the danger zone, and countless new buyers are living right on that edge with zero financial cushion. That is a massive red flag. When people have no breathing room, any economic shock, like a layoff, could unleash a wave of forced sales. This is the most critical part of this video, and it is the warning you cannot ignore. The second chart compares housing inventory. Now, on the surface, 2025 looks nothing like 2008. Back then, there was an enormous glut of homes for sale. Today, the supply of existing homes is historically tight. This is the number one argument people use when they say, this time is different. But they are missing the hidden story. While the supply of existing homes is low, the inventory of newly built homes has absolutely exploded, piling up at a rate not seen in over a decade. This is creating a dangerous two-tiered market. Home builders are not like regular homeowners. They can't afford to sit on empty properties. A builder with a cheap mortgage doesn't exist. They must sell. And to do that, they are getting aggressive. They are buying down mortgage rates, paying closing costs, and quietly slashing prices. Mega builders are now acting like their own private banks, offering deals in the 5% range to move inventory while the rest of the market is stuck above 6%. This is the crack in the ice. This shadow inventory of new homes creates downward pressure on the entire market. If you're trying to sell your home, you're no longer competing with the house down the street. You're competing with a billion-dollar corporation that can afford to destroy its profit margins to make a sale. This is the exact pattern we saw in 2007, when builders were the first to signal that true buyer demand was vanishing. The final parallel is the market's mindset. In 2006 and 2007, the mantra was, real estate only goes up. Today, there's a new, equally dangerous belief. The lock-in effect will prevent home prices from ever falling. The theory is that since everyone has a super low mortgage rate, nobody will ever sell, keeping supply low and prices high forever. But this ignores a fundamental truth. Life happens. People lose jobs, get divorced, pass away, and have to move for family emergencies. The lock-in effect is not a permanent shield. It's a dam holding back the natural river of housing supply. As the economy cools and financial pressure builds, more and more of these forced sellers will have to list their homes. And when they do, they will enter a market where buyers suddenly have choices, especially from builders, and far more power to negotiate. The belief that prices can't fall is just as dangerous today as it was in 2007. Now that's what the national data shows, but real estate is always local. So I want to hear from you. What are you seeing in your city? Are prices still rock solid, or are the for sale signs staying up longer? Help us paint the full picture in the comments below. If you're getting value from this breakdown, do me a huge favor and hit that like and subscribe button. It helps us get this independent analysis out to more people. I need to be perfectly clear. This is not a prediction of another 2008 style crash. A total catastrophic collapse is extremely unlikely for a few key reasons. First, we don't have the toxic subprime loans that poison the financial system. Lending standards today are far more strict. Second, most homeowners have a massive equity cushion, which protects them from immediate foreclosure risk. And third, the US does have a genuine long-term housing shortage. So if it's not a crash, what is it? It's a slow grind down, a prolonged market ice age. Instead of a sudden shocking drop, we are likely facing years of stagnation where prices drift sideways or bleed out slowly. This type of market is treacherous in its own way. A crash is quick and obvious. A slow grind is a trap. It creates a generation of homeowners who are house rich on paper but cash poor and completely stuck. It can trap anyone who bought in the last few years in negative equity for the better part of a decade. This isn't a tsunami that you can see coming. It's a slowly rising tide and the water is already up to your ankles. So what should you actually do? That depends on who you are. Your number one risk isn't your home value being chopped in half. It's illiquidity. You might have hundreds of thousands in equity that you can't touch without selling your home and giving up that golden mortgage rate. Your best move is to make yourself financially bulletproof. Aggressively pay down high interest debt and build up your cash savings. Treat your home as a place to live, not as an ATM. The message is simple. Be patient. The balance of power is shifting back to you, slowly but surely. A buyer's market is already here in many parts of the country. Watch the new construction market like a hawk. As builders get more desperate, they will offer the best deals. Keep an eye on total inventory in your target zip codes. When you see both new and existing homes begin to pile up, your moment is getting closer. If you absolutely have to sell in the next year or two, you need to hear this. The window to get peak 2022 prices is closing fast. The competition from new homes is real, and it is growing every single month. You must price your home to sell the day it hits the market. The fantasy of listing 10% high and sparking a bidding war is over. Be realistic, be prepared to negotiate, and understand that your first offer is very likely to be your best one. The warning signs are flashing, but they're not pointing to a 2008-style collapse. First, the affordability crisis has stretched household budgets to the breaking point, a dangerous echo of the pre-crash era. Second, the inventory numbers are telling two different stories, with a hidden surge in new construction creating downward price pressure that most people are ignoring. And third, the widespread belief that the lock-in effect makes prices invincible is creating a false sense of security, trapping people in a dangerous mindset. This isn't about fear, it's about data. The housing market isn't about to fall off a cliff, but it is undergoing a fundamental shift. The age of easy money and guaranteed gains is over. We are now entering a long, slow grind. If you want to stay ahead of these changes with data-driven analysis, make sure you subscribe and click the bell so you don't miss our next report. And for a deeper dive into how this is affecting specific cities, watch this video right here on the markets that are most at risk. Thank you for watching.